Welcome back, student. Once we finish it, building the assumptions and schedules with basic information and 10Q, the schedule, which is Schedule A, sales budget, the Schedule B, cash collection for customers, purchase budget, and cash disbursement for purchase budget, and operating expenses, the disbursements budget. Then we should create a construct budgeted income statement for the quarter end and cash budget for the December balance and the budgeted balance throughout the quarter. And then we'll compare the actual, the last, the quarter of the financial statement. Okay, once we create those of schedules, now we are ready to complete this budgeted income statement first. Budgeted income statement shows the performance of their business activity, right? Where do you get this sales, right? We have the budgeted sales, here we go. And then let's just drag. And then let's cost of sales. You can put just positive number or negative number, doesn't matter because we are using this financial statements for the internal use. But in order to identify if this number is expense or income inflow or outflow, I just want to use negative sign. Then where is this cost of goods sold? Yeah, on the Schedule C. And then let's just drag it to the right. And then we have the gross profit of the budgeted month throughout this quarter. And then we got it. Now, the research and development, also the expense, right? We created this budgeted operating expense throughout this period. And selling general and the administration, also the expense, which is negative. Then let's drag it to the right so that we can collect all this number from the schedule. And then total operating expense is the sum of these two. That includes, by the way, the depreciation, right? And then let's drag it to the right. Now we got the operating income. How to calculate it? Right, the sum of this gross profit and operating expense, which is negative number. There we got it. Other income, if your company has been creating other income, now that is the positive, right? When you calculate total disbursements, now the reason why total disbursement of operating expense as a negative number in the operating income is that this operating income is not expense, but the income, right? So it is positive as well. Now, income before tax, the less income tax, because at the end of the day, in the cash budgeting part, if you borrow money, that produces interest expense. That's why we cannot complete this part yet. And then that interest expense will change this other income or expense part. Okay, so let's leave the blank just as it is, and then we'll come back. But the quarter end is just the sum of, right, those 3 numbers that we already calculate, by the way, here. But yeah, I just want to calculate here. Okay, and then let's just make this line for identifying the result of each, right, the account. Okay, then let's go to the cash budget side. The beginning cash balance is the balance at the end of the last quarter, right? Where do you get it? Right, here you go, the cash balance of the last actual quarter, right? And then we need to carefully understand your cash budget policy, right? Required minimum cash balance desired is assumed that you need to keep the actual ending balance of cash from the last quarter, which is 34,050, the same amount every quarter. At least you want to maintain this amount, right? And then property, plant, and the dividend, the income tax, annual loan interest, the rate, we have those assumptions that we that will be used in creating the cash budget. Now, the required minimum cash balance desired is, as indicated in this assumption, is 34,050 in case that you want to expand your business and use this cash in case, right? Then, okay, but you can change this required minimum cash balance along with your business model. But in this case, well, right, we just assume that we are using this cash balance. Then the available cash balance is 0, expecting that we are collecting cash, right? I pay the disbursements of purchase and operating expense less than these collections. But if the cash out is greater than the cash in, then we have to borrow money in financing, right? So collection from customers, where do we get it? Right here, cash collections. There you go, 22. That is the positive. Now you have to clearly indicate the negative or positive number because that shows cash direction, right? And then payment for merchandise. Payment for merchandise, where do you get it? Right, this disbursement, the payment, actual payment of this schedule on the cash budget. So we collected this amount as a negative number, right? So you got it. And operating expense cash out, also negative from the schedule here. Now 2,144. Again, this other income and non-current expenses, especially non-current expenses of depreciation, is not the actual cash out. That's why when you calculate the operating expense in actual disbursement amount is now reduced. Okay. Now we just collected this amount. Tax amount we haven't calculated yet, but we'll come back this cash amount, the tax. But at this moment, we don't have any interest. We won't have any the interest because even though we borrow money, that borrowing money is the money at the end of the month. Right? So the tax amount here, and then equipment and purchase, we have also assumption that the company on the property, plant, and equipment, we assume the company purchase the difference between the property, plant, and equipment of the actual and on the 10Q, you found this property, plant, and equipment of your balance sheet. If this property, plant, and equipment between the period has been increased, that means we are using this amount on the increased amount of equipment purchase, right? So how much is that? That amount is now property, plant is this 1,849. And then the tax, let's calculate the tax amount first, because again, even if the total the excess of cash before financing is greater than the cash collection, we borrow money based on the period end, right? So we don't have any interest, so we can just calculate the income before tax here, and then less income tax is now 10.77%. We found this actual on the right here tax rate on the 10Q as well. Tax rate, there you go, right? Effective tax rate. And then we got this tax amount. I just want to use this tax rate throughout this period. And then net income of the month is now, finally we got it. Now we apply this tax amount from this calculation. And then net cash receipt and disbursement is the sum of all this operating and investing. Excess or deficiency of cash before financing is available cash balance is definitely zero because we started from the beginning balance. We want to maintain that beginning balance. So there's no available cash balance at the beginning. So the sum of this net cash receipt and disbursement and available cash balance is still, excess, still the deficiency of cash. Do you have dividend? No, we don't have dividend because the dividend paid in December. We're expecting this dividend paid out at the end of the period. From where do we get this dividend, the balance? Now dividend here on the 10Q. Also, we found the dividend last quarter is 3,713. We assume that the same amount will be distributed for the budgeted period. Borrowing loan, then how much do we need, right? We need this amount, right? But once we borrow money, then it should come to positive because cash in. Do you have any interest? No. Again, we don't have any cash the interest because borrowing occurs at the end of the month to cover all the deficiency of cash in full. When cash is available for repayment, the repayment occurs at the end of the month. Interest is paid in cash at the end of every month, assuming that the 12% annual borrowing rate, right? But the monthly borrowing rate is definitely 12% divided by 12, which is 1%. That will use to calculate the interest expense. Do you have any repayment of borrowing? No, there is no repayment of borrowing because we just borrow money, right? Then what is the total cash from financing? Total cash from financing amount is now the sum of from these financing activities. So we got this number from the beginning balance plus minus this, right? Because that is the cash of deficiency, but we covered this total cash from financing, this amount from the financing, right? So we maintain ending balance 34,050, which is the beginning balance of the November. And then we also want to have this required minimum cash balance on December. Then available cash balance is still zero. And then let's collect all this information from the schedule because I just linked those numbers, right? And then it is now dragged automatically. And then tax amount, we need to calculate tax amount, right? Tax amount, just leaving the blank for a while. And then there's no equipment purchase because we assume that this property plant equipment purchase from the 10K, right? And then let's get this interest expense first so that we can come up with this the income tax of November, right? So how much is the interest amount from loan, right? That is the principal, right? Times 12%, right? Divided by 12, right? That is the 12% of 12 divided by 12. It is 1 month's borrowing interest rate. Then it should produce like this. 245 is the interest, right? Then this interest should be now included in the other income or expense so that we reduce this amount, right? And then the income before tax is now reduced by the interest. And then less income tax multiplied by 10.77%. Then that amount is now is the tax of November. We don't have the equipment purchase. And then net cash and excess cash, now we get this number, right? That means that from operating and investing on November, now the company has 5,422 on November. We don't have the dividend, right? And then definitely not necessary to borrow additional money. interest from loan, and then repayments. How much can we repay? 5,422? No, because the company should pay interest as well, right? So that amount should be the same as the sum of these two, right? Sum of these two. So 5,177, 245 is the total amount of excess cash before financing generated by, right, collection of money and payment of all the expenses. Then total cash balance is the sum. Total cash from financing is the sum of these financing activities, right? Then what is the ending balance of cash? Right, the sum of the beginning cash balance and then excess of cash before financing from operating investing, and the total cash from financing. Now, the same way we start this December balance from the ending balance of November, and then we have also the same balance of the required minimum cash the desired, and then available cash balance we assume there's no, because we want to maintain and keep this amount on hand. And then cash collections and the tax amount. Now, let's calculate it that way. The tax amount, the operating expense. Got it? And then tax amount is what we want to calculate. First, the interest from loan again. How much is the new balance now? New the borrowing balance, right? This for 24,000, and then we repaid this borrowing loan, right? And then times the interest is again 12% divided by 12 months. Then it should be negative because cash out. So this 194 interest on December from borrowing loan should be now added to the operating other income and expense part, right? That changes the other the expense from other income now. Got it? And then the income before tax is now sum of these two, and less income tax applying the 10% of interest rate. And then we got the net income, right? Calculating the income before tax minus income tax. Now this tax of the last month is we got it. Then the equipment purchase, there's no additional the purchase. And the net cash receipt and disbursement is the sum of this the operating and investing. And then excess deficiency of cash before financing is the sum of this available cash balance and net cash receipt and disbursement from operating and investing. Now we need to consider the dividend paid in December. The dividend is now 3,713. And then do we need to borrow more money? No, because excess cash before financing is greater than, right, the dividend. So we have enough cash to distribute this dividend, and there's no additional borrowing, but there's interest. Then how much should be the repayment of borrowing loan, right? This repayment and minus the dividend cash out and interest cash out, all the financing activities. So sum of this financing cash out is the same as the excess cash of the finance before financing. Then ending cash balance is now we got the same balance as the beginning cash balance before budgeting. Okay, then we completed. The next part is creating the balance sheet, budgeted balance, to compare the last balance at the end of a quarter in actual and the budgeted, right? And then we also compare the the balance at the end of December with the budgeted balance as well. So we only change the balance we have like assumed and then we have budgeted. the other the balances like vendors, non-tradable receipt, or the marketable securities, we will not change this. Based on this assumption. So cash balance is the beginning balance, right? Oh, sorry, the ending balance. Ending balance, October. And then let's just drag it to the right. Marketable securities, we assume that there's no changes, right? So, because we don't have any assumptions before. Accounts receivable net is now, we have to get this number from right here. Credit sales of October. Why? Because credit sales, that means we haven't collected cash yet. That means we have a right to receive the cash on credit, right? That means the name of account, the accounts receivable. So 18,000, 23,000, 26,000 is exactly the same as the credit sales of each month. Inventory. What is the inventory? Right, the inventory is the ending balance of inventory. Yeah, we budgeted. So where is the ending balance? There you go. 6,000, 7,000, and 7,000 each the month. That is the inventory. Vendor trading, non-traded receivable. We assume there's no assumption. We assume that just it stayed the same level. Then other current asset, we don't have any budgeted schedule, just we collected that number, which is the same as the last balance. Then the total current asset is the sum of those. And then let's drag it to the right. The marketable securities, we don't have any schedule assumptions related to the account. Then property, plant, equipment is now we have to develop this amount from the last quarter by adding equipment purchase, right? Equipment purchase. There we go. And then, oh, this should be minus, because minus means the positive, right? And then you need to subtract depreciation, right? The depreciation is accumulated in the property, plant, and equipment as the accumulated depreciation account. That's why we say this property, plant, and equipment net. And then we got 39,542, which is the property, plant, and equipment net balance on October. And this amount will be also reduced by, right, one more time, this depreciation next month as well. So we have the decreasing balance of property, plant, and equipment. And then ending balance is 37. And then you will compare with this. And then other non-current asset is 44 from the ending balance at last quarter. We don't have any other assumptions related to the account. And then total non-current asset is the sum. Now the sum of this non-current asset part. And then let's drag to the right. The total asset is sum of total current asset and non-current asset. And then we have a total asset balance of December, right? And then we found that the December balance of total asset has been, right, increased. And then current liability section is a little bit challenging part, accounts payable, because account payable is now we use the credit. The company has been using the credit for purchase from the vendor, right? But what is the obligation to pay the cash at the end of each month? That is the accounts payable, right? We found here on the schedule 90% of purchase. I want to fix this times what is the actual purchase amount. We create this purchase budget, right? There you go, 14,500 92. Right, so we have this one, 13,000, right? That is accounts payable balance. In the same way, let's just drag it to the right side, and then we collect all this number based on our assumptions. 90% of months after purchase, which is obligation to pay cash to the vendor, with the December balance and the purchase of 90%, which is accounts payable of the December balance. Other liabilities and deferred revenue and commercial paper and term debt. We don't have any like assumptions of this number, right? So let's just assume those numbers stay at the same level. But we have additional loan payable balance, right? Loan payable balance, which is a short-term loan, is generated from this borrowing, right? So we put this borrowing, 24,539. It should be now reduced by, right, actual payment, right? The repayment of this borrowing, and will be reduced by the following, right? The repayment of the borrowing loan. So the remaining balance is the 15,000. Now the total current liability is the sum of those numbers. Let's drag it to the right side, and then we don't have any assumptions related to the liability, the non-current liability. So let me just put this number. Then, oops, done with this too. Then let's just drag it to the right side. So the total liability is the sum of the current liability and non-current liabilities. Then we've done. We're almost there. We're almost finished. The common stock and additional paid in capital. The company has not financed from this issuing of the additional common stock, so it is still fixed, right? But the retained earnings now should increase by net income, right? What is the retained earning? The sum of all the net income or net loss the company has been generated, right? Each month has increased by the net income, and then last month should also increase by, right, the net income, which is cumulative. But you should remember we also have the dividend payment, which has the source of the retained earning, right? The last month should now reduce by the dividend. So the retained earning is 27,972. Accumulated other comprehensive income is miscellaneous account that doesn't have any assumptions. And then total shareholders' equity is the sum of these three. Then let's drag to the right. Total liability and equities is total liability, a sum of these two, right? And then let's drag it to the right. Then the balance of total liability and equity and the total assets should be the same, the balanced out, okay? Okay, then once we create this balance sheet, we just double check. But the slightly different imbalances between total asset and total liabilities and equities in your cases definitely can be accepted, because the different assumptions from the actual of your company can be applied. For example, the September sales of this number, I generated this number by using some solver program because I don't have the actual balance of the sales amount of the 1 month, the last month. That's why I ask you to calculate the, the, the average monthly sales is actual quarter sales of the last quarter divided by 3 so that you can get this number. But in your case, the slightly different the balance result, total asset and total liability and shareholders equity can be acceptable. You're totally fine. Okay, that's all. So all the explanations of the assumptions and the schedules, and then analysis of your budgeted income statement and the cash flow statement, cash budget, and the budgeted balance sheet should be explained on the Word file, especially the changes of the accounts. For example, accounts receivable. You don't have to explain the other the name of accounts that doesn't have any assumptions that result in any changes between the actual and the budgeted balance of last month, for example. Okay, but all these income statement changes and quarters should be explained on the Word file. Okay, you guys, very good job. See you in the classroom. Bye bye.